All right, good afternoon, ladies and gentlemen. It's Thursday, so it is Finom Group's State of the Market. I am your host, Seth Golden. I'm joined by Brad Carter. You can probably tell by the graphic here as we kick off this week's State of the Market. We've got a pause button. I'm sure by now everybody knows what that means. As of yesterday, we got the Fed's what proposes to be the last rate hike of the rate hiking cycle or campaign. They dropped some key language within the Fed statement that used to discuss ongoing rate hikes. So they dropped that terminology, which is the indication that they're going to pause, they're going to look around, let some of their already implemented measures over the course of the last year play out in the economy and make data dependent decisions. Within Jerome Powell's press conference yesterday, they also talked about quote unquote the bank crisis. I don't know that we should be using that terminology or not, but that is what the financial media is calling it. What the Fed also stated was there's likely some contagion in the sense that there'll be stricter credit conditions that follow a banking crisis. We've already seen credit standards by the regional banks and the large national banks tighten over the last couple of years, and that's a thing to recognize as well. Any manner of further tightening of credit conditions, tightening of credit standards by the banking system has been going on for the last couple of years, keeping in mind that coming out of the pandemic, credit conditions were as loose as they can be. Credit standards were as loose as they can be, and they've only tightened ever since. How much more they'll tighten because of this banking crisis, which is, we're talking about maybe 3 banks, remains to be seen. But the unknown obviously has disturbed the Fed. It's disconcerting to them. I don't know that the Fed ever thought they had control over the situation. I mean, let's face it, they've hiked rates at the fastest pace in history, knocking 3+ percentage points off of CPI. But to the extent that it's really damaged the economy, we just didn't see it. We just didn't see it. Now, clearly they broke something. We've had these banks with mismatched term structures within their portfolios that couldn't be hedged or weren't hedged. But from here, I guess my question, Brad, is, do you think the Fed is less confident about their policy tools going forward? I guess that's how I'm kind of looking at things. Is that Jerome Powell didn't seem terribly confident at the podium yesterday.
Yeah, and I think that's a lot of what hurt him in particular yesterday. They've said all along, Jerome said all power to do, and he's kind of stressed that a little bit here and there. But yesterday, the way he answered the hard questions just sounded, at first I thought just ill-prepared. And then today I started thinking, he may just be not sure how to answer this banking stuff. Just like you and I were talking about off air, that he has no clue what the fallout's going to be. And but still, I felt like, knowing how he felt about it, he should have been better prepared to answer those kind of questions, and he just simply wasn't.
Yeah.
And he exuded everything but confidence. Mm-hmm. He could have just in a relaxed way said, we figure there will be some a little bit or a minimal amount of impact on credit standards and so forth, but we're just going to have to wait and see, and said things in a way that made it sound like, we've got we've got control over this.
Mhm.
We're not worried about it. But he looked and sounded worried.
Yeah.
He just,
To
yeah.
your point, there was there was a lot of stumbling. There was a lot of, pauses, and you can tell when somebody's looking for the right words. And, so it takes too long to answer the question. And I get it. We don't know what the fallout is from some nuanced bank out on the West Coast that primarily cater to venture capitalists. Like, we don't know, how other institutions are going to react to that. We heard from Citi's CEO yesterday saying this is not a bank crisis. Her words: "This is not a bank crisis. The banks are well capitalized. This is nothing like 2008."
Right.
From her lips to God's ears. But at the same time, this is why I say I think the Fed was always very concerned about how they could manage through this 40-year high inflation regime. And I just don't believe they had a feel for it. It's one thing to see what happened in the, but we can all read books and we can all go look at charts from the 1970s and 1980s and see that, when inflation was there, the Fed's rate was here. And, we never got even close to either of the 1970 levels of inflation or the 1980s, let alone the fund rate getting as high. But if you don't have a feel for price and a feel for the flow of the economy, and then you have something like this happen, right, where we have to do some kind of bailouts, even though they were for depositors, they weren't for the banks themselves, they were just to make depositors whole. I can understand how you would be nervous, anxious, and not feel like you're in control of the situation. To the extent that you hit the pause button, in some sense, that basically is the telltale sign. You guys don't know if you should hike or cut at this point, because you don't know what the fallout is. You don't necessarily know the impact of, right? Because, if we're going to have credit conditions tighten, usually that's a very strong disinflationary force, if not an all-out deflationary force. Why'd you hike at all? Why did you hike at all?
I'm flabbergasted at their rationale, because they could have very easily and eloquently explained why, we've decided to go ahead and pause now for about 30 days and take a look at things.
I think that would have been the best course of action.
And just admit,
Yeah.
Because, and he could have just said, and if the numbers don't look good in 30 days, we may have to go another quarter basis points or something, but he just, I'm not sure that was even Jerome's call. That's the thing that bugs me a little bit here. We've got a Fed, I think, right now that a lot of times, if there's actual dissent, it's not going to show up. That you're going to, people are going to say their piece, but then they're just going to get in line with the flow. And I can't help but wonder, Jerome's not particularly hawkish or dovish, really. If you look at the whole thing, he's one of those that's kind of on the line, a little dovish maybe, and he may have been a bit uncomfortable with that raise. I just don't know. I'm speculating.
Yeah. Within the Fed's release, they showed it was unanimous decision. But to your point,
right,
most of them will just agree. They'll say their piece. So it looks like nobody dissented, but I'm sure there was, some folks that had consternation about how this would be perceived. We just bailed out depositors. We had 3 banks that are failing, if not failed, and we're hitting the pause button, yet we're hiking. It's difficult to wrap your head around. It's very difficult. So, all right, well, we've got some Fed stuff to get into. My quote here to kick off our SOTM this week, I say, avoid at all costs. If you're bullish on the markets, you are probably only digesting bullish data points. If you are bearish on the markets, you are probably only digesting bearish data points. Seek balance, not bias. Just taking the facts, folks, taking the facts, whether they are perceived bearish or bullish, just taking the facts. Not all facts are going to lend themselves favorably to investors, and not all facts will lend themselves negatively to investors, but you got to be digesting the facts as they are, trying to remain as objective as possible. Here are this is the Fed statement, and this is what changed in the Fed statement. You see right there, it's crossed out. Ongoing increases in the target range will be approached. So they crossed that out. That was the first sign, and that's what the markets initially reacted to. This basically told you that there's a pause. So they took that out, and that's what the market initially shot straight up, digested that move, of course. And there was very little change in the dot plot as well. The dot plot, basically says it's going to top out at 5.13%, which was almost equal to the last dot plot we got. Right. So there wasn't much move there. And that was interesting. Bank of America Global Research says we lower our expected terminal rate to 5% from, well, they were at, I think 5.5 to 6 in the past. So they lowered it from to 5.25%. And I'm basically only showing you this. People have to realize that nothing that the Fed offers, the dot plot is just a projection. It's not a forecast. Their SEP, or Summary of Economic Projections, is just a projection of where they think the economy is going. Obviously, that's not a forecast either. So when we see all these big money center banks, Wells Fargo and JP Morgan and Morgan Stanley and Bank of America, talk about and give their outlook for where the terminal rate is, they're always open to modification. All of the Fed's entire policy is completely malleable and flexible. So, just because, one bank says this and the other bank says that doesn't, it's not cemented. You have to realize that these are going to change as the information changes within the economy. What happened yesterday? I saw a lot of headlines. This was hilarious. So you had Jerome Powell and Janet Yellen at the same time, basically, giving their testimony, if you will. And Jerome Powell does his thing, gets off the stage. I think it was maybe 3:20 or so. And Janet Yellen is testifying before Congress, or I don't know, the Senate maybe. And within that, she stated that the Treasury is not looking to broadly, fully insure depositors, right? And so the financial media decided, well, that's the reason the market sold off in power hour, from 3 o'clock to 4 o'clock. I'm like, what are you talking about? The Treasury doesn't have the ability to do that. Is the financial media really think all investors are idiots? That is not, the Treasury just can't, willy-nilly say, oh, we're going to insure all depositors. Forget 250,000 by the FDIC. We're going to do it, 100%. Like, they don't have, that has to be done by Congress. Nonetheless, all the financial media was saying, well, Janet Yellen said this and the market went down. It was very coincidental. But the reality is, yesterday's price action, as showed right here, I mean, it was mirror image. This is the usual under Fed Powell, under Jerome Powell as the chairman of the Federal Reserve. Historically, this is how Fed Day plays out. And it goes down in power hour. And this was yesterday. I mean, that's algorithms. That's how it works.
Yeah, the other thing I noticed is, at least some of the media, the little I heard, we were on the road the last couple of days, so I missed a lot. But they were trying to portray it as though there was a disagreement between the Fed and Yellen, and it's just not there. Nowhere would Jerome Powell ever say the words, "We're going to guarantee all the deposits in all the banks."
Right.
It's just not going to happen because, like you said,
Right.
they don't have it. They have emergency powers, and and to be honest with you, I'd like to bone up on those a little bit, but obviously they're able to do a lot in a given situation, but to just change policy, no,
Right.
they can't do that.
Yeah, it was just ridiculous, those headlines. And we started out today's trading session fantastically. We were up 2% on the NASDAQ. We were up 1.5%. We literally took back everything that we lost in Power Hour here this morning. Did Janet Yellen change her mind? Of course not. There was no headlines. Just again, further evidencing that the only thing that happened yesterday was the algorithms did what the algorithms did, and which was produce the usual or the average trading day on a Fed day under Jerome Powell. That's it. Now, today we're getting sold off because around midday, we had you could argue a big headline from Walmart, right? Walmart's the biggest retailer in the country, obviously, and the biggest employer in the country. And it said it's going to lay off hundreds, not thousands, but hundreds of workers at their e-commerce facilities. Right. I think 4 or 5.
Only their e-commerce.
Yeah, exactly. Now they've been investing in automation for the last 5 years. So they don't need as many workers. And they're also rationalizing that the e-commerce business that they had grown through the pandemic doesn't need these many workers anymore because shopping habits are normalizing. So, but either way, you have yesterday's pause and this real dichotomy in policy by Jerome Powell and rather shaky language in his Q&A session. And then you compound it with this headline today from Walmart, and what do you have? You have a lot of uncertainty, and investors would rather shoot first and ask questions later. What I would say is you're never going to have certainty, folks. In the market, you never have certainty. You've got to learn to, have a standard deviation of certainty, as I like to say. So that gain is completely wiped out in the S&P 500. We were above 4,000. It almost 1.5, 1.75, completely wiped out within 2 hours after that Walmart headline came out. It's just too much for investors right now. They don't know. They hear banking crisis, banking crisis, banking crisis. They have uncertainty from Jerome Powell, and then this. Folks are not willing to wait it out. I love this. Every year, SPIVA or S&P Global comes out with their performance study of equity fund managers, and they look at how many are underperforming, the benchmark, the S&P 500. And so the percentage of U.S. equity funds underperforming their benchmarks, the S&P 500, over a 20-year period, almost all 90 percentile, folks. Almost all. S&P 1500, S&P 500, large cap right there, 96% of fund managers. 96% underperform the S&P 500 over a 20-year period. Over a 1-year period, again, here's the S&P 500, and it's only because it was down last year, 54% underperformed. Over a 3-year period, 68% underperform. Over a 5-year period, 84% underperform. 10-year period, 95% underperform. The professionals, right? The professionals. All right. Latest survey by Bank of America, Merrill Lynch, their fund manager survey that comes out every month. Investors now the most bearish they have been since the start of 2023. You can't get these guys to be optimistic. When you get these levels, though, historically, that's been the low in the
Yeah.
market. The low here, lows in the, European debt crisis, the lows in the first quarter of 2016, June of 2019, before we took off again. And there, of course, was COVID. And usually these are the best times to buy. This chart where you have the striped green lines coincides with these bottoms in the fund manager surveys. Up and away, 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 COVID, up and away, and here we are now. So, all right, well, we'll see how this market does. We've got only what, six trading days left, I think, here in the month of March, right? Or the first quarter of the year. We've only got about 6 trading days left. And so I thought it would be a good idea to refresh our December low indicator. And what that basically signifies is that historically, if you don't retest the December low in the first quarter of the new year, almost every single time the market gave you a positive return for that new calendar year. In fact, the times that you have had it red, it really hasn't been. There in 2011 was exactly flat, and there in 2015, down less than 1%. If you add in the dividend, you were positive. So the S&P 500 was at 3783 was the December low, 3783. So as long as we don't avoid that, history looks pretty good, folks. History looks pretty good. But as we know, history doesn't always repeat, so we have to keep an open mind. Now, the Fed did just hit the pause button. Is that good, bad, or ugly? As we've talked about in the past, these are the previous occasions when the Fed hit the pause button. 84, 88, 94, 2000, 06, 2018. And the forward returns right there, folks. The average 12-month return since 1954 is 14%. There's been 13 occasions where the Fed has hit the pause button going back to 1954. The average 12-month return is 14%. Naturally, probably not going to go up in a straight line. I think today and yesterday are perfect examples of that. Keep an open mind. What else? Let's see. So a good chart analysis by Tom Bowley recently. He wrote this article. And we talked about volatility regimes and how you usually go from a high volatility regime to a low volatility regime, back to a high volatility regime to a low. It just ebbs and flows like that in the markets. Last year, starting here, 2022, this is the S&P 500 on the bottom panel. This is the put-call ratio, the equity put-call ratio in the top panel here. And we can see that puts outnumbered calls by a massive degree last year. And so you had a higher volatility regime there. I mean, the S&P 500 went in the opposite direction. Usually you go from a high volatility regime to a low volatility regime. And so if we go back in time, we can see that playing out. Low volatility regime to high volatility. Low, high, low, high, so on and so forth. So we got pretty extended here. Fast forward to today, and we can see in the chart the put-call ratio has rolled over here in the new year, 2023. We've rolled over, and the S&P 500 has been trending higher for the most part. But we'll see if this persists. But usually this is a sign that you're, transitioning to a lower volatility regime. And we do have a lower average VIX here this year, but we're only 3 months into the year. And we've seen our first print of a 30 VIX just last week. So, all right, the consumer price index, folks. One thing to take note, because we've seen this chart before, these are the different components within the CPI. What I noticed from the end of December using the same pie chart, this is transportation in the dark shade here. 16.7% of CPI is transportation. It used to be 18% last year. At the end of the year, they did this reconfiguration of CPI, which lowered the transportation portion of within the CPI. However, the housing or shelter owners equivalent rent went from 42% to 44.4%. We've talked about eventually that shelter and owner's equivalent rent is going to make its way into this CPI. And when it does, it's going to hit like a sledgehammer. Even more so because it has even more weighting than it did last year. Bespoke Investment came out with this really great chart here. Potential paths for year over year, not month over month, but year over year headline CPI through June. Because what we've also talked about is we're on the cusp of these really high comparisons last year. When did CPI have its biggest jump last year? February, March, April, May, right? As soon as the Russia-Ukraine war began, we had these big spikes in energy prices and commodity prices. Everything just went haywire. Well, now, we're going to be lapping those with really low energy prices, really low commodity prices. So if the CPI on a year over year percent with, let's say the month over month print is 0.2, so that would take us down to 2.3%. We would be at 2.3% by May 2023 on the year over year headline. So really good chart showing the magnitude, basically, of the comparisons are just out of whack. People just can't rationalize right now how quickly we can go from 6% to 4 or 3 or even 2% CPI by the end of the year, simply because all of these high comparisons are going to fall off. And that's, again, before we can really know when those shelter and owner's equivalent rent are going to seep into the inflation data. This chart here, so I said keep an open mind because things that have never happened in the past have been happening since the pandemic. This chart right here is from Stanley Druckenmiller. And what it identifies is that once inflation gets above 5%, so CPI gets above 5%, above 5% in these occasions here, above 5% like it was already in the present period. But once it gets above 5%, it's never come down below 5% without the CPI going above 5%. And this is why I say keep an open mind, because here we are. If this is the last rate hike for this regime, then we're not going above 5%. This will be the first time. So we got to keep an open mind. We've talked we're talking a lot about CPI. We're talking a lot about inflation because inflation is what drives the liquidity pivot. Or disinflation is what drives the liquidity pivot. We had a lack of liquidity as inflation was increasing. And now we're going to have more liquidity because inflation is decreasing. Inflation is the liquidity pivot. It's not the Fed increasing its balance sheet. It's the inflation. We've gone from 9% down to 6+%. If your carton of eggs were $3 and now they're $2, now they've come down to just $2, don't you have more money to put into the economy? Of course, that's liquidity. And so what we can see in the S&P 500 from this chart here from Renaissance Macro Research validates that. We've had a liquidity spike. This panel here in the bottom is net liquidity, 1 month percent change, and look what happened. You have this liquidity spike within the S&P 500. What happens when you do have this liquidity shift? Well, historically, here's all the returns from past illiquid cycles. The numbers line up with their 12-month forward returns. The only one that was negative was number 12, and that looks like the great financial crisis. I doubt that's what's going to happen this time. So, important notes there. People are still fixated on rates. You know, they still believe that rates determine the outcome in the S&P 500. So this is just reiterating U.S. stock market average returns 1928 to 2021. Rising inflation, falling inflation. So these are the 12-month returns in the S&P 500. When you have rising inflation, you still can earn 5.5% historically. When you have falling inflation, you earn a lot more. But rising rates, it doesn't matter. Rising rates, average return 9.7%. Falling rates, 9.6%. This does not determine. There's no difference here. This does. It's inflation. All right, let's see what else. Okay. More doom and gloom from the Morgan Stanley crew. These notes from Morgan Stanley: global equity performance versus number of occurrences. Morgan Stanley, what happens when one or more of these 5 things are happening? 1, 2, 3, 4, 5. What happens when one or more of these 5 things are happening? The S&P 500 forward earnings are declining. You can still get 4.2% average annual return. When the yield curve is inverting, okay, so now we have the yield curve down and earnings are declining. Well, your average return is declining. Unemployment below average gets worse. Manufacturing PMIs less than 50. Average return is even worse. 40% of banks tightening lending standards. So when you have all of these things happening at the same time, the average return has been negative 4.5% for the S&P 500. What I would debate, though, is that the forward earnings are declining. I think that's still in debate based on what we've already seen from early reporters here, in the new year, and what we've seen happen in the fourth quarter. So I think this one is that's still debatable at the moment. All right, so we are 3 weeks into this banking crisis, Brad, and wouldn't you know it? And don't get me wrong, Johnson Red Book retail sales have been decelerating greatly, right? It's because the comps were so high, and we had double-digit comps through much of last year. Now, things are normalizing. You're not going to do that year after year after year. Amazon didn't grow revenues 40% every single year. Eventually, they grew 30%, then 20%, 15%, so on and so forth. The laws of large numbers catch up to you. But 3 weeks into this banking crisis, and we actually have a 3-week high in Johnson Red Book retail sales. That's how bad it is out there. This banking crisis is leading to a 3-week high in Johnson Red Book retail sales. And the beauty of this is you can keep track, week after week. You can have a sense of consumer spending, a sense of the health of consumption in between when the Census Bureau releases their monthly retail sales data. And here's the other thing. So we have a 3-week high in Johnson Red Book retail sales. We also have, since the start of this banking crisis, jobless claims. We have 10,000 fewer jobless claims. That's how bad it is. We have 3-week high in Johnson Red Book retail sales and 10,000 fewer initial jobless claims. It's a banking crisis, right, Brad? This is a banking crisis.
Yeah, it'd be interesting to go back and look because, 3 banks failing in a calendar year is not as big a deal as a lot of people would think. But I think it'd be more interesting to see how many of these banks failed in pretty good economic times.
Well,
Credit Suisse, I mean,
Yeah.
that's been a basket case for a long time. It just happened to be now.
Oh, I'd argue Credit Suisse is not. Yeah, I mean, Credit Suisse stock has been going down forever and a day.
Yeah, yeah.
I did go back and research since 1971 how many bank failures we've had. We've had over 90. I forget the exact number. I know it's in the 90s. About 85 to 88% of bank failures happened. Oh gosh, bear with me, folks, because this is a good question, and I did research it. I think I tweeted it. ZCL bank failure. Sorry, folks, I should have been prepared, but it's you raised a good point, Brad. Come on, bank. Let's see, failure.
You can see that Seth and I don't start with a list of questions.
I did it just the other day. Oh, well, here's a good one also, by the way. Remember when Mester and Bullard were talking about 50 basis points? They would have been okay with a 50 basis point hike. Remember that back in February, Brad, when they were doing their speaking engagements? And I said, this is a bad idea. They really should not do that. The Fed came down to 25 basis points, but you had two non-voting members who felt, well, it doesn't matter, I mean, we're not voting members. We could have, we could say this. And I'm like, no, you can't. James Bullard specifically, he is the go-to. And I said, Mester Bullard talked Fed into a box that they will need to talk themselves out of. It would be a big mistake to stair step down from 70 to 50 to 25 and then back up to 50 basis points. It's okay when the market wasn't pricing 50 basis points, but when it does, and it did, the market shortly thereafter started pricing 50 basis points, you have a problem to squelch. Else you risk a dollar risk event. What happened to the dollar? It went from 101 up to 105.50. A week later, this was February 24th. That I tweeted this out. We talked about it in the trading room. I'm like, this is a really bad idea to be talking this way. 1 week later, SIV, Silicon Valley Bank. 1 week. All it took was 1 week. Knew it. All right, where's these? I know I've got this bank failure list. But that's the kind of stuff we talk about in the trading room. Because these are important to understand the ramifications of the Fed's language. Gosh, how many? Let's see. I know. Bank fail. I tweeted out literally just the other day. Now I can't find it. Let's see. Let me go back. Bear with me, humans. It's good data, in my opinion. I know it was like 90%. And most bank failures happened during the Great Financial Crisis, naturally. Come on. Just pass it. $21st. There it is. There we go. There have been 91 bank failures since 1973. 41 happened during recessions. So most of them happen outside of recessions. Most bank failures happen outside of recessions. 35 of the recessionary bank failures occurred during GFC, the Great Financial Crisis. Only 6 occurred with inflation above 5%. So it really isn't inflation that does this. It's the Fed went too far too fast and threatened to do a stair step back up. And all of a sudden, you have bank failures. They caught these banks off sides. They thought that this was going to be stair step down to a pause, not going back up to 50 basis points again. And the bank suffered for it. So there you go, folks. All right, moving on. But good question. Did I interrupt your thought there, Brad? I'm sorry.
No, I was just feeling bad that I asked you that question at the wrong time.
All good. How much could I'm not gonna, I want to get your take. I'll give you my take with regards to the economic outlook. My take is pretty simple. We've had PMIs below 50 for what? 4 months now?
Oh,
And right around 50 for at least 6 months, right? I mean, we'll call it 6 months worth of contraction in manufacturing. We've had the leading economic index down 11 months in a row. We've had the yield curve inverted since, I don't know, June, July of last year, maybe even sooner. And no recession. There's got to be something holding this up, right? So now throw on that. And by the way, credit standards have been tightening this whole time. So now throw on a banking crisis and maybe credit standards tighten even further. Does that kick us into a recession? And that's the framework I think folks have to look at it. If those other factors, which have a more closely correlated, outlook for the economy, if they didn't do it, like 11 months in a row, the leading economic index has been down. Usually you're already in a recession. Historically, you're already in one. And we might print 2.5% to 3% GDP for the fourth quarter. So if somebody asks me, well, do I think this will do it? And a housing recession, sorry, I forgot that. A housing recession too, Brad. Although the home builders are doing just fine. But a transactional recession, that's what we should call it. It really isn't a housing recession. Home prices are down minimally on a year-over-year basis. It's a transactional recession. So you put all that together and we still don't have an actual economic recession. If somebody asked me, do you think this was the final straw, this bank crisis that possibly leads to a fallout, in credit conditions, blah, blah, I would say probably not. Do I think it softens the economic outlook? Yes, it does. It doesn't help it. Even tighter credit conditions are not going to help the economy. It's just another headwind, if you will. But how much of that will be offset by continued expansion in China, which will demand our exports, right? Or imports to China. So now our exports are going up. Like, how much is offset? And if their manufacturing is coming back, generally our manufacturing comes back. We already saw a slight uptick in the last ISM. I don't know if it'll be consecutive months of it, but there's something going on there in ISM that says we may have seen the bottom. So I would say, the recent bank failures don't help. But I don't think this is going to be the undoing. I don't think this is going to be the undoing. I still see, a path to continued expansion through at least the first half of the year. And I go back to the same thing. Look at the excess savings here, folks. Has it come down quarter after quarter through 2022? Absolutely. But we're still talking about more than, right around $1 trillion in excess savings today. About $1 trillion in excess savings. And that's with inflation coming down. When inflation is coming down, real wages are going up. Look at the price at the pump today compared to last year this time. We've got a lot of disinflationary forces that can also offset some of the quote unquote needs for lending. What do you think? What's your looking forward at least through the end of the first half of the year? How do you think this all develops given the recent events? And mind you, Walmart just said we're laying off hundreds of workers, not thousands, but hundreds. And by the way, folks, Walmart is giving these workers 90 days to find additional employment or, new employment. But they'll also be eligible to work in stores. They can go work in their Walmart stores.
I can't argue with anything you just said. I mean, we've both been talking like that for quite some time. I did want to throw in something interesting, and I'm not going to state this as a fact, but in the back of my mind, I'm thinking I'm right. It'd be worth looking at. Going into the Great Recession, people didn't have money. The savings rates were horrible and so forth. So we weren't as prepared, as we are now. And I think that helps to explain why, housing prices continue to stay pretty elevated, even with the higher interest rates. I remember it was last summer, I think, one of my brothers who buys and sells real estate and manages some cabins and so forth was telling me how much these houses have dropped. I said, Bruce, look at the year over year. You're looking at asking prices. Yes, asking prices did finally have to flatten out, and some markets actually came down because they were getting so crazy, including in the market he was in. But today, I think I could sell my house for more than I could have 12 months ago, but less than I could have 2 months ago, maybe.
Yeah.
See, we're talking about asking prices. We're not talking about year over year changes in actual sales prices. So it just feeds to your point that Americans are in pretty good shape. They say increase credit. Well, you have to be real careful with that. Sometimes I increase my credit line just because some company says, we'll give you 0% for 18 months. And I go, okay.
The available credit versus credit that's actually used are two different metrics.
Right.
Yeah. Well, I still think that there's a glide path here for a soft landing. I do see softness ahead, but I see it more as a rate of change issue. We still had strong economic growth last year. When you look at nominal GDP, not the real GDP, which can be, massaged a lot, by inventories and the trade deficit, but nominal GDP, consumption, very strong last year. It's just hard to, comp to those levels again.
Yeah.
So
I think if we have a recession, to most people, it's not even going to feel like it.
Yeah. There's still too many job openings.
Yeah, our frame of reference tends to be the Great Recession.
Mm-hmm.
That was a really awful.
Folks are still anchored there. Yeah,
a very unprecedented time in our history, and of course, we can tell from the hard data that's coming in every month that we're not anywhere near.
No. I think the better comparison might be 1990 or the kind of the 1994, where you had, the devaluation of the Russian ruble and the long-term money management crisis. But those were near misses in a minor recession in 1990.
Yeah. I'm wondering how many people viewing this later can remember the Great Recession of 1994.
Yeah. Exactly. All right. So real quickly, talking about earnings, right? Because I said that earnings were debatable. Morgan Stanley says they're declining. They're going to continue to decline, so on and so forth. And I'm not saying he's wrong. I'm saying that the data at hand does not support what Morgan Stanley is forecasting. Last week, the 3-month percent change in S&P 500 forward earnings, the positive percent change in forward earnings was 60.4. We had troughed down here about 47. And it's been getting better ever since. after, some of these late earnings that have come out, i.e. Nvidia, Adobe, FedEx now, and Nike yesterday, we've jumped up to 61.5. So when these guys, these Morgan Stanleys of the world, these Bank of Americas, are pounding the drum that it's getting worse, it's not. There's no data to support that. It's not. Bank of America behind the scenes, because this is from Bank of America themselves. Despite several recent bank failures, the global earnings revision ratio continued to show remarkable resilience in March and was unchanged at 0.79. The ratio jumped Europe from 0.83 to 112, and Europe is the only region with more upgrades than downgrades. But Europe was supposed to have the recession first.
Yeah.
Sometimes you just think that because they're in such close proximity to each other on Wall Street, they just drink from the same punch bowl. They just, they don't have a perspective, outside of Wall Street's narrative. They're all in the same towers. They're all in downtown Manhattan. They all read this from the same script, basically. But this is real updated data every single, this is every couple of days as earnings are coming out that we can get this update, and it's not getting worse. It's just getting better. This doesn't tell us what the actual earnings results will be for Q1 2023. It gives us a purview that says it's likely not as bad as the down 6% that FactSet is currently forecasting. In Q1, they're expecting negative 6% earnings growth on a year-over-year basis. Data's not supporting that at the moment. It really isn't. So we'll see what happens. All right. I think in this environment, we've got some quantitative data or hurdles to overcome. We don't want to hit that. We don't want to retest or undercut that December low. Things are obviously choppy. There's a lot of headlines. There's a lot of information that investors are having to digest right now. And some of it, is going in one direction and some is going in the other direction. I just don't think that's lending well to a risk on appetite from investors. But I go back to what I said earlier. You're never going to have certainty in this market. If that's what you're looking for as an investor, the all clear signal or absolute certainty, you're probably, in the wrong game, as I would say.
Every year since I've been doing this, when it's a good year, which is most of them, by the way, by far, you're always climbing some wall of worry all the time. We've talked about 2019 more than once.
Mm-hmm.
There were a lot of points in that year where a lot of people.
There were 4, 5.
I'm getting out. I've had enough.
Yeah, there were more than 4. I think there were 4 5% or greater. One was an 8% pullback or consolidation. I mean, that year was just tormenting. But if you didn't buy each and every single one of those dips, you just sat on your hands, you would have.
That's why I sort of loosely said in our regular chat that this year kind of feels a little bit like that, because we'll go up a little, then get thrown back and go up a little. The one difference is so far, haven't we, since that big start in January, we've stayed right about between 38 and 4.
Yeah, and that's why we do need a breakout. Because if we don't break out, and I think the breakout level is 4,200. If we don't break above 4,200, at some point in time, we are going to break down, because you are going to have the current sentiment compound. And then all it's going to take is just one piece of kindling to start the fire, and the floodgates open up. So yeah, that's the danger here this year, is that we are ping-ponging, between those levels, as you said. But if you don't break out, eventually you just break down. So that's the level that 4,200 is, that 50% Fibonacci retracement level as well. So that's a real big feat of strength that the Bulls have yet to see, and would need to see in order to become that much more emboldened or confident. Until then,
and so I would say, kind of what you've been saying all along anyway, is that what we need to do as investors is just watch the data. Because if the data keeps coming in kind of like it is, that the earnings aren't so bad and inflation's coming in, we're going to have that breakout. You know, if we don't have the breakout, there's going to be data backing up why. So we just need to be, that's one thing I really like about the service you provide here is I don't have to spend so much time hunting down data because you get it all done for us. And if I didn't follow a single one of your trades, I'd buy the service just for that.
Appreciate it. Well, with that vote of confidence, they say leave on a high note. So, wishing everybody out there, we got one more trading day this week, and to end the quarter next week. Happy trading. Be safe out there, and
one more thing, Seth. I promise that was not a solicited comment I made.
Oh, yeah. Your check's in the mail, right?
No, I really meant it. And those of you that have kept up with me since I got active again last year know that Seth and I have been working together since 2011.
Yeah.
So way back, and I haven't ever cut the service, except, well, no, you cut my service when
we got bought out. We got acquired in 2015.
What was the name of that? Capital Ladders.
Yeah, we got acquired in 2015. We had a 2-year non-compete, so we couldn't do anything until.
And then later you emailed me and told me about this new deal, and so I got into that. So
all right, we're gonna wrap it up here. Happy trading, everybody.